Is it possible to accurately time the stock market?
Stocks are sectors of joint stock companies that investors buy and sell to make profitable money. By investing in stocks, one becomes risky with the way they handle their money. The market is so unpredictable, so that is why researchers create methods, such as Michael Beale Higgins' method of buying low and selling high. It is not often that this turns out to be the case. By using technical analysis, an investor will look at patterns in historical data to predict future closing prices. Fundamental analyzers look at economical factors as well as volume. By asking the question, what would happen if an investor were to time the stock market, specifically investing in the S&P 500 index? It is then hypothesized that if an investor were to time the stock market, then their performance in the short and long term will be susceptible to volatility. Even more so, it will result poorly. It is important to understand factors that affect the market, such as internal company developments, political uprisings, or even social media. Access to the S&P 500 index as well as its volume were required during the experiment. Excel was also used in the process to track the data. The procedure was simple. Mark calendars, set up Excel documents, record data, create graphs, and then analyze the graphs to make conclusions. This graph gives an overall view as to the performance during the S&P 500 index while it was tracked. This graph dates back to November of 2014 through November 13th of 2015. It was used to predict a trend line over the tracking period. This graph analyzes the previous one where it was complete with the rest of the data. It continued on a negative slope. The volume was also taken into contribution when it was analyzed against a date, showing how many people bought and sold stocks during the day depending on its activity. The results were able to support the hypothesis very well. Therefore, it is not possible to accurately time the stock market. The two techniques worked out well. By using a more statistical approach against a more economical approach, the results appeared around about the same. Both seem to occur neither accurate, but further studies may show different results for different dividends. It is rare for someone to be able to time the stock market because it is so volatile. By now, we would know if someone had the ability to because they would be quite famous. Investors' performance often results poorly. They fail to take into account the factors that affect the market, whether distant or recent, as analyzed in the two approaches.